More money making. Today I want to talk about alternative asset classes you can invest in within your portfolio. How they generate returns, what the risks are, and how liquid they are. For a discussion on the main asset classes you can invest in, namely equities, bonds and properties, see my previous video. As always, if you like what you're watching, please destroy the like and subscribe buttons and notification bell for the YouTube algorithm. Asset classes are defined as groups of investments which have similar characteristics and behave in a similar way. How you decide to blend together these different types of investments will determine your expected return, risk, and liquidity. Complementary asset classes can actually reduce the total risk of your portfolio. Alternative asset classes are commodities, hedge funds, venture capital, currencies, cryptocurrencies, collectibles, and structured products. They're primarily used by sophisticated investors and tend to have at least one of the following characteristics: extreme price volatility, low or neutral expected returns, a very illiquid market, or higher minimum investments. But you'll also find a redeeming feature which makes it attractive to some adventurous investors with a high risk appetite, so they may be included in a portfolio in sensible amounts. First, let's talk about commodities. A commodity is a resource like oil, gas, or gold used by manufacturers as raw materials in their production processes. You don't normally hold commodities directly, as it's highly impractical. In terms of returns, investors aim to sell in the future for a price higher than they buy at today. In terms of risk, there is a chance that even over the long term, the commodity won't rise in value or barely keep pace with inflation. Also, if you decide to invest in something like gold by purchasing gold bullion bars, there is security risk and insurance is essential. There is also a counterparty risk with commodities if entering into derivatives, which is a contract between two parties where the other party could default. In terms of liquidity, it varies depending on the method used. Derivatives can be freely traded over the counter with banks or other market participants. Shares in collective commodity investment schemes such as exchange-traded funds can be bought and sold quickly like equities. Physical commodities are less liquid as you need to manually find a buyer to fulfill a sale. Now let's talk about hedge funds. Hedge funds basically back some equities over others. They're far less regulated than other funds, so they can engage in risky investments. They can also borrow heavily to leverage bets they make. In terms of returns, these are generated in the same way as equities, namely through dividends and capital gains. In terms of risk, the fund's holdings may be undiversified and their strategies may not work well or completely backfire. They require much more active and skilled management, which leads to high investment costs. Even then, they often don't beat market returns, but they're designed to have a lower correlation with the overall stock market, so can actually reduce volatility. In terms of liquidity, this can vary, where some funds only open their doors to new investment periodically, with a limit on withdrawals, so the fund manager can make illiquid or long-term investments without the risk that withdrawals mean they have to sell at low prices. Now let's talk about venture capital. Venture capital is investment in unlisted businesses. You can directly invest into a company or via a venture capital trust, or VCT, that collectively invests into various small to medium-sized businesses with higher risks, but also higher rewards. In terms of returns, this is your profit from successful startups minus your losses from failed startups. In terms of risk, investing in new ventures involves a high level of uncertainty as well as a high risk of failure. In terms of liquidity, you can sell your shares at any point in theory, but in practice, you lock your investment in for at least 5 years. When you do sell, it can be difficult to find a buyer for shares in VCTs compared to other types of company shares. Now let's talk about currencies. In terms of returns, speculators can bet on the fluctuating values of different currencies by what's called trading forex, hoping to buy low and sell high. In terms of risk, there is a risk that you buy high and sell low. There's a poor investment case for long-term growth since it's not possible for the entire market to rise. It's a zero-sum game. In terms of liquidity, currency is very liquid so long as you accept the current valuations. Now let's talk about cryptocurrencies. They're a subset of currency, but are digitally managed, often in a decentralized manner using blockchain technology. A key difference to currencies is that the core design of Bitcoin only allows a finite number to ever be created, so value increases as demand rises. In terms of returns, investors aim to sell in the future for a price higher than they buy at. Since its inception in 2009, Bitcoin has seen huge gains. In terms of risk, future increases in demand are not certain. They could even be outlawed or rendered obsolete. There is also no limit on the number of competing cryptocurrencies, so there is a debate over the finite supply argument. There is no way to determine its inherent value, and speculation makes the price very volatile. In terms of liquidity, like for currencies, cryptocurrency is very liquid so long as you accept the current valuation. Now let's talk about collectibles. Collectibles are any objects that tend to hold their value over time, like art, antique furniture, classic cars, vintage wines, and sci-fi memorabilia. In terms of returns, investors aim to sell in the future for a price higher than they buy at. Investors in collectibles have often seen excellent returns exceeding 10% per year. Niche items can be sold nationally or even internationally at auction houses to the highest bidder. In terms of risk, the market for collectibles is very fickle, where some items increase in value and other items become worthless. Being able to tell the difference requires a great deal of skill and expertise. There is much more awareness of the industry these days, meaning items are less rare and hence less valuable. In terms of liquidity, collectibles are relatively liquid as they can be sold at auction within a few weeks. But a good price will depend on the caliber of bidders present. Now let's talk about structured products. Structured products are unusual as they have some high-risk characteristics and are complicated in how they work, but are marketed to complete novices. They are a blended investment product which usually combines a bond with derivatives. In terms of returns, they offer a certain percentage of return, such as 8% per annum for 5 years, if a named stock market index remains at or above its starting value at the start of the investment term. In terms of risk, if the index closes lower, they may receive no return, usually only losing capital if the index has fallen significantly. So returns are quite volatile to index price changes close to the maturity date. They will also only pay out the advertised return if the counterparty to the derivative contracts is able to make good on its obligations. In terms of liquidity, they're invested for a fixed term with usually no provision for early exit. How you build your investment portfolio is up to you. Sometimes an effective investment portfolio contains nothing more than equities and bonds. Others may include 5 or more different asset classes. More isn't always better. In the next videos, I'll discuss various example portfolios. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.